Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending April 24th, 2020. I'm Preston Brent. Thanks for tuning in. This week's theme is, well, I did it a long time ago, but he's still there. Humpty Dumpty is still sitting on a wall. What we've seen this past week, this was the first week in a couple that we've seen the U.S. markets move down. The Dow was down just under 2%. Year to date, it's down about 16.7%. The S&P was down about 1.3% for the week. Year to date, it's down about 12%. NASDAQ was only down 18 basis points for the week. Year to date, it's only down 3.77%, just off the opening for the year. The Russell was a rare green one. It was actually up 1 basis point, but year to date, it's the only one still in a is down 26.07%. And the VIX actually came down a little bit. It fell about 5.8% for the week. It started the week at 38.15 and we closed at 35.93. But keep in mind, the VIX, the markets are starting to settle in a little bit, but we're going to have elevated volatility for months to come. Okay. In the world markets, everything was also in the red. The FTSE, the London markets, was down about 60 basis points. The French markets, the CAC 40 was down about 2.35%. DAX was down 2.73, and the Nikkei was down 3.19. China was down a little over 1%. Hang Seng was down about 2.25%. And if we look at the U.S. markets here, the weekly sector performance, the best performer, believe it or not, especially given all the turmoil in early part of Monday and Tuesday this week, was oil and energy. This sector was up 1.89% for the week. But the worst performing sector for the week was utilities. It was down about 3.6%. And just looking at the trailing PE ratio of the markets, it's at 22.54. The forward PE ratio, price to earnings ratio, is at 20.98. So that's a reduction of 6.9%. I still think we're a bit elevated here, and we got the annual S&P dividend yield is still hovering around 2.14%. But that's still a heck of a lot better than the 10-year interest rate at 59 basis points. So that's going to continue to channel money into the equity markets. Okay. But even though we've seen this global pandemic here in the U.S. has claimed about 50,000 lives, if you look at the S&P this past week, as I said, we're still down only about 16% from our all-time peak. Really amazing. And I think what that's doing is it's clearly puzzling a lot of analysts here who've been calling for more downside action for the past month or so, ever since we've bounded higher. And they're just really calling for markets to roll over significantly here. We've seen thus far, we've had like 26 million have filed for unemployment, and that probably even understates really the extent of the job losses, given which could give us, I guess, the month of April, we could see unemployment move in the mid-teens to even the high teens. I've seen analysts say over 20%, but we'll see. But clearly over in the teens. And this is what's amazing, is just off of our all-time low, or a half-century lows that we had just in early February of 3.5%. But we saw also, as I mentioned, oil go into a really wild negative spin down into that little depths of Dante's hell. It was a negative price level as the May contracts dipped to over a -40, basically with no place to put it. But against all this backdrop, we're going to get the Fed meeting policy statement this week. I think it's going to be more of the same. We're going to expect interest rates to stay kind of pinned near 0%. And they're going to maintain a heavy pace towards balance sheet expansion, supporting the markets, credit markets as necessary. The near term, I still see more of a deflationary tone rather than an inflationary tone. Although longer term, I think inflation is going to win out. Remember, one of the things that's going to help push inflation along, which has really kind of helped keep it in check over the past couple of decades, is globalization, because we've offshored a lot of things that reduce cost to the consumer, to companies, but that's had a significant blowback to the U.S., primarily as we've offshored a lot of things to China. Now, a lot of that's going to come back. We're going to see global supply chains shifting, moving around, bringing a lot of things back here, and that is going to also spur shifts towards higher inflation, including fiscal policies like infrastructure build out, things like that. So we're going to see inflation come back, but I think near term, at least this year, I don't see it happening. And by the way, Europe is also a mess. I mean, it's probably even worse than the U.S. Germany's spending massively, which is so uncharacteristic of German government policies. They don't spend hardly anything, but they're spending a lot to support their own economy. Italian economy really sucks right now. Same with Spain. Most of Southern Europe's in dire straits. The Italian bonds are starting to rise again. The yields are starting to go up. There's a lot of bickering going on as European officials try and figure out some sort of coordinated fiscal package for its weaker members, which means mostly the southern countries in Europe. And then throw on top of that, we got emerging markets aren't looking that promising as well either, with a lot of their currencies falling against the safe haven US dollar for the near term. Now, longer term, I'm also bearish the dollar, but near term, no. And we're seeing fewer exports coming out of some of these emerging markets because there's no one left to buy them, right? So again, since March 23rd, we've seen price action in the S&P up almost 27% off the lows since March 23rd. But a lot of that strength is just centered in a few big cap stocks: Facebook, Microsoft, Apple, Amazon, Google. A lot of those five big caps account for 20% of the entire S&P, believe it or not. Okay. But keep in mind that the rest of the economy is still in dire straits right now. Okay. And we're going to see, once we get out of this post-COVID crisis, there are a lot of other things that's going to prevent the markets from really longer term moving higher like we've seen over the past decade. I mean, I can name a number of things, but one of the other things that's going to come down from where it was, especially last year, is a large drop in corporate stock buybacks. I mean, over half the S&P companies and about 25% of the Russell 2000 companies bought their stocks last year, or bought back some of their stocks last year. So the estimates by analysts, and just listen to some of the companies and how they spend their money over the next 12 months, certainly going into 2021, is that stock buybacks are going to drop by 20%. And that's also been very supportive of the U.S. economy and stock price action to the upside. So we're going to see a lot of changes coming out over the next 12 months. Now, if we look at this chart right here I have on the screen, it's Fibonacci's off the low, and you can see generally in just about every bear market, and clearly we're in a bear market and we move very quick. When you have fib nodes like this off the lows, very rarely does it get up above the 50% level. Generally, it'll come up to the 23 or the 38% level, maybe even in the half, and then it'll roll back over and then possibly make new lows, or at least start to form a low. Okay, but generally new lows. We've seen that in the dot-com bubble. We saw it in the '08 financial crisis. But here we're up over the 50 percentile level. So when you start getting up in this level towards the 61% level, then that bodes well for the low already being put in. Now, that does not mean we can't have a move lower. It bodes well for a low having already been put in. Just looking at how price action moves around bear markets. Okay, you can see here that the upside fib node at 29.31 is going to be a hard resistance zone. Also notice I've got on here, now these are EMAs, not SMAs, but I got the 50 EMA and I got the 200 EMA. And you can see on the 50 EMA, we're back up above the 50 EMA again on this chart. And this is a daily chart here. So just understand that we're sitting above in a nice zone here, but the 200 is sitting just north of the 61 fib node. So I'm looking for a little bit of a pullback, at least to the 38 percentile level, possibly down to the 2600, maybe just a little bit lower. I do believe that my line in the sand has always been this upsloping trend line right here. And as we move forward in time, it's going higher and higher, but probably around the 2500 level, as I've told you guys over and over, that's my line in the sand. I think we could come down to the 26, maybe see 2550. I don't see much more than that. If we do take that out, that means it's going to get uglier and we're going to come down and make new lows. But at this point in time, I don't see new lows being made. Now, if I put it on a 240-minute chart, well, let me just put it back on the daily for a second, and I'm going to take you over to an Ichimoku, show you a little bit more detail here. Now, in the Ichimoku, as you can see here, I've got a different set of fib nodes on here. These fib nodes are based on a long-term pattern of the financial crisis. So my fib node that drew the lower pivot point was the lows made on March 9th, 2009, and the higher fib node obviously was made in this high point that we made in February of this year. You can see here using these longer term fib nodes just where we're sitting. Now we're in this green cloud here, which for those of you that don't understand Ichimoku, I highly encourage you to come in and check out our option masters. I spent a lot of time on it. It's a very great, it's really not a chart. It's more an indicator than a chart. But it really shows you a lot more than just simple moving averages, especially the way these moving averages are calculated, which incorporates volatility into the moving average, which is why you can see both of them. They kind of don't move like a typical moving average. It's more rounded. These are more jutty and flat and things like that. But you can see here that I've got overhead resistance. I've actually got two levels here that we're looking at. And we held the first level. This was the level that I had talked about for quite some time, right? This was my S1 zone, first level of support that I was working with our members on, all right? And you can see in this S1 zone, it runs anywhere from 2752 to 2728. And we've held it very nicely. Okay, now the one thing I was looking for was this head and shoulders pattern. I'm not really sure if it's going to print, but if it comes down and prints and breaks, then the 2600 level, as I talked about earlier, would be the measuring objective of the break of this neckline right here. But right now, it does not look like that is going to be the case. But then again, you never say never in this market. We follow price action and it tells us where we want to play. Okay, and that's the best way to do it. And you can see the cloud has shifted to red as we go out in time, which essentially means that this suggests a little bit more downside is going to be coming in the future. All right, which would tell me that we can come down to this S1 zone right here fairly quickly. The R1 zone is sitting up here from 2853 to 2884. Okay, and so we're going to see where these markets really want to take us. And how they want to play itself out. Now I'm going to shift the screen just a little bit here, so bear with me 1 minute. It may take a second to come up on the screen for you guys. Let me just get it over here. This is screen number 5, so I'll wait for it to paint on the screen there. It's going to be the same S&P 500 E-mini futures, but I'm going to move it around a little bit, and you're going to see all this support underneath. I mean, we got a ton of support. My original objective when we started coming down hard um, was, so what we've got here, I just had to take a quick pause here for just 1 second, but we're still live and recording. You can see on here that we've got a resistance zone right here. Here's the 50 EMA. We're sitting just above it. And these are the support zones right here. But as I said, we got some very large support zones down here. My original was down around 2000 right here. Okay, that was my original area. But I don't think we're going to get down there. But you can see this was the pre and post Brexit vote, the overnight Trump election lows. The lows that we made in this recent move down was that red line there, 2174. I think we're going to come down and possibly test this area right here, which is the 2700. I think that is going to be a wider zone for us down below. I'm not sure if we'll get that far, but we could. I would not be surprised to see us get down there, as I said earlier. Okay, I think the near term, we've got earnings, some big earnings coming up this week. Okay, we've got if we look at this week on Tuesday, we got AMD, but we got Google, Caterpillar, UPS, which is in the transport area, and then on Wednesday, we get Q1 GDP numbers. We also get on Wednesday, we get ADP, CME, Facebook, MasterCard, Microsoft, Tesla. So we get some more tech on Wednesday. And then Thursday, we get Amazon and Apple. and Visa. So we've got some huge, this is going to be a big active week for earnings. And on Friday, we rounded out with Chevron, Phillips 66, Exxon Mobil, which are going to be really bad. But we get all of these rounding out the week. And in the middle, we get the FOMC meeting minutes or the FOMC policy statement, as I said earlier. By the way, with this active week, I just think the odds favor a little bit of downside action in these markets. So we've got to be very careful how we go. And of course, if we look at volatility, if you look at the VIX, you know, it's come down dramatically from these highs here of 85.47, which, it's very difficult to stay up in this area here for a long period of time. But we're back down here, but I can see it coming back up and just retesting above 50 for a short period before it rolls back over again. Okay. And if we come over here and look at treasuries, if we look at the bond market finished Friday up 16 ticks. We're sitting here at a very hard level to move up higher. If it does move up higher, I'm going to be interested in shorting the bond market. Okay. But that's kind of where we're sitting with bonds. There's a lot of it supported by the Feds, obviously. And if we get the 10-year interest rate, you can see the 10-year rate is sitting at 0.59, 59 basis points off the 2020 lows, but not by much. Okay. And if we look at the US dollar, it was down Friday, but it's still relatively supportive to the upside. Longer term, as I told you guys, I want to be short the dollar. But short term, I think the dollar, as long as the countries and everything or as long as the other currencies are weak and they're having their own issues against the basket of currencies, and the dollar is going to be a kind of a safe haven for us. Okay. So that's just what I'm seeing on the currencies. And then, of course, if we come over and look at gold, gold was essentially flat on Friday. You can see the highs that were made back on April 14th at 1788. I think gold's going to run sideways a little bit. Longer term, I will be bullish gold. Short term, believe it or not, I still believe it can come down just a little bit, right? I think you can get a better price if you're not in gold now. I think it can do a little bit better. And then, of course, if we look at copper, as I told you guys, I was bullish copper back over here. Infrastructure spending, they're going to try and get an infrastructure bill. I don't know how successful they're going to be, but I can see, but as the company comes out of this post-COVID-19 crisis in later this year in 2021, going into 2022, I think copper is going to do fairly well. Okay, so that's a little bit about where I'm sitting on some of these key metals, both precious metals and gold. There are other areas in gold and ways to play it that I will review with our members this Sunday evening. Of course, let's look at oil. I mean, you can see with oil, you can see where it went to on that May contract. It was down to minus 40.32 intraday. And then we've had this big move up. So that's why it performed fairly well this week, just because the low was so ugly. Now we're in the front month of oil, which is at 17.18. So we'll see where this wants to go. The fear, as I put it on the chart, is the zero rate. So storage is it's not something you can just build storage tanks right away. So that is going to continue to be an issue until Russia and China continue to cut production. I think they're going to start cutting here in the US as well. Okay. So and by the way, for members this Sunday, I've reviewed with you a better way to play the oil markets. You do not want to use USO. Now, keep in mind, USO is very cheap right now. They're going to do a reverse stock split this coming Wednesday. They're going to do a 1-to-8 reverse split. So USO is going to do that. And they're going to change some of the way that they do it. It used to be based on the front month oil futures, but they're going to spread it out a little bit more to try and alleviate some of the issues that they had this past week. But you don't want to be in USO. That is just the wrong way to trade oil longer term. Members, I'll review that with you this Sunday evening. Okay, so that's a little bit about where we're sitting. There's a lot of stocks out there that we're in, some that I like, some that are more day trade oriented. Members, we'll go through some of those details tomorrow evening in our weekly market watch. If you're a non-member, hopefully you guys have come on in and join us. We're having a good time making some money. I will see you guys next week. Members, I will see you on the inside tomorrow evening for our weekly market watch. Have a great evening, everybody. Thanks. Bye now.